When I watched their presentation, I found it very convincing and I was very intrigued by it. I think the fact that they were able to turn things around to the extent that they have is heroic and very inspirational. And I'm quite happy and very comfortable having this stock in my portfolio. So for those of you who are new to my channel, as I imagine all of you are, my name is Justin. I'm a former financial consultant and now I am a financial technology engineer. What that means is I build financial platforms that are used by businesses and some platforms in the consumer space as well. So I'm very close to the industry, having worked in both the consultant side, giving advice, and also working as an engineer, building the systems. Now, although I consider myself to have a very strongly informed opinion, on this channel, I am just presenting information. I am not giving financial advice. Today I'm talking about dividend stocks, in particular, which 5 stocks I think are the best ones to invest in going into the end of 2023. For those of you who aren't familiar with dividend stocks, these are shares of companies that pay out a portion of their earnings to their shareholders on a regular basis. So they're a great way to generate passive income and they benefit from the growth potential of the stock market. Now, some people feel that they protect against volatility because of the dividends may offset the short-term price fluctuations. Now, personally, I think that's a bit misleading. The reality is that if you have a dividend stock and that stock decreases in value, it doesn't really matter how much dividends it's paying, because if the stock price drops, then a 10% yield on a stock that's worth half as much, that's not a good investment. So me personally, I'm not much of a day trader. I don't make short-term decisions. I think long-term when it comes to stocks. Everything that's in my portfolio is something that's going to remain there for the next 5 to 10 years, or possibly longer. So all the stocks that I'm featuring in this video are stocks that I expect to remain paying dividends and to remain profitable in the next 5 to 10 years. And I've made that decision based on a number of different factors. So although I do look at charts and past performance, the most important factor to me is the financial health of the company. So I typically look at is their quarterly, biannually, and their annual reports and presentations. I find those to be key sources of information. It lets you know the sentiment of a company, it lets you know what their intentions are, and it lets you know what their future plans are. So going through these stocks today, I'll be talking about a number of different key pieces of criteria. So for me, that will be the dividend yield, the dividend growth, the payout ratio, the history of the dividend, and also the dividend cover. And I should probably also mention the share price, but that doesn't affect my decision whether or not to invest in a stock. All of the dividends and dividend stocks I'm presenting today are available as fractional shares, meaning you can buy a full stock or you can buy a partial one. So say you only had £10 to invest this month and the stock costs £50, then that £10 will give you a fractional share that's worth 20% the value of the stock. So you can still benefit from this even if you're unable to buy full stocks. So just now I threw a bunch of terms at you. Let me break those down into plain English, starting with the dividend yield. So that represents the annual dividend payment as a percentage of the stock price. Now, a higher yield might be indicative of more income potential. However, it could also be a sign that the price of a stock has gone down. So on its own, it's an attractive metric, but it needs to be combined with the other metrics. So we'll move on to dividend growth. Now this is a sign of financial stability in a company because it shows the increase in dividends over time. So by that I mean every year they are paying more in terms of percentage, but also in terms of the actual figure each year. And that's typically quite a positive sign. So the next 2 terms we'll talk about are dividend cover and dividend payout ratio. Now these two go hand in hand, and there are 2 different ways of looking at the same thing. So essentially the way that these are calculated is for dividend cover, it is earnings per share divided by dividends per share. And for the dividend payout ratio, it's the reverse. So it's the dividends per share divided by earnings per share. So I'll give you an example and we can look at some figures here. So if you had a dividend stock that had earnings per share of £2 and it was paying out dividends of £1, that would be dividend cover of 2, and that would be a payout ratio of 50% because half of the earnings are being paid out as dividends. Now, these are two metrics that are very important to me as a long-term investor because I want to make sure that I'm investing in stocks that pay out dividends consistently year after year. And ideally, these will be dividends that grow. So if there is a low dividend cover and a high payout ratio, that means a company isn't holding back much money for their dividends. So what I mean is, if their earnings were to fluctuate and go down, and they've got a low dividend cover and a high payout ratio, that would mean that they would have to potentially reduce their dividends because there's just not enough money to cover them. So these two metrics are something I'm going to mention a lot when I'm talking about these stocks that we're going to go through. With the companies I've chosen, some of them pay out quarterly dividends, some of them pay out 2 dividends per year. It's completely within their discretion, but what's good is that they've all signposted when they're going to pay them out. So I will mention the months in the statistics with each of these dividend stocks as we go through them. The next piece of criteria for me is a company's financial health. Now, I use Moody UK because they give these companies and these dividend stocks a rating, and you can see their rating system just there. And for me, this is a very strong indicator of a company's financial health, and of course if a company has a strong credit rating, then they are a lower risk investment. So the first dividend stock that we'll talk about is Rio Tinto. They're one of the world's largest mining companies with a focus on iron ore, copper, aluminium and diamonds. They operate in the UK alongside 34 other countries, and they have over 53,000 employees. Now, what I like about them is the fact that they are a very low risk investment and they have a great dividend track record. Now let's talk about their stats. So if a dividend yield of 5.6%, dividend cover of 1.6 and a payout ratio of 62.5%. Now those figures all make me very happy. And their investment rating is AA3, which is also something that makes me very happy. They pay out their dividends twice a year, so they pay them out in March and August. So I've looked for Rio Tinto's half-year report. They haven't released one for the third quarter yet. So these are their half-year financials. So you can look there, you can see that they've got strong progress. They've got a really beautiful cash flow, some wonderful earnings there, and they've been quite good with their dividends. Let's look at the dividend-related data in particular. I love the wording on this. Attractive dividends remain paramount. I mean, that's what you want to hear. So they've got shareholder returns of 40-60% of underlying earnings on average for the cycle. They've had a 50% payout in line with their policy. And look at this consistent 7-year track record on shareholder returns. I mean, that's lovely. This is a very reliable investment. You can see this company is quite profitable and they are paying out their dividends. So what I like about Rio Tinto is that they've clearly outlined their pledges to sustainability and net zero emissions. So they're committed to having net zero emissions by 2050. Now, spoiler alert, all these companies have pledged that. For me, this isn't a big piece of criteria whether or not to invest in a company, but I do think it's worth acknowledging when a company has made sustainability efforts. I'm very happy to have them in my investment portfolio. They're going to be there for a long time. So the next dividend stock we'll be talking about is BP, one of the world's largest oil and gas companies. They have operations all over the world. They're in 70 different countries and they've got a very strong presence here in the UK. Now, BP has been transforming itself into an integrated energy company. So what they're doing is they're focusing on low carbon solutions and renewable energy sources. They've actually pledged to reduce their oil and gas production by 40% by 2030. Now, they also plan to invest $5 billion per year in low carbon businesses, and they want to do that by 2025. Now, that's all quite important, and I like the fact that they are focused on sustainability. I also love the fact that they said a resilient dividend remains their first priority. So now let's go through their statistics. So they have a dividend yield of 4.6%, dividend cover of 1.3, and a payout ratio of 76.9%. Now, I'm quite comfortable with that. And they have an investment grade of Baa2, which I'm also quite happy with. Now, their payout dates are March, June, September, and December. And I like the fact that their dividend has been paid quarterly and consistently for the last 10 years. I should also add the fact that they've been paying out dividends since 1993. So now let's have a quick look at their financials. So with BP, we're quite fortunate they have very up-to-date information. So looking at the third quarter of 2023, they've actually released an investors report and an investors presentation, and that's what I'll be going through with you now. So looking at the financial frame of 2023, you can see that they've got a resilient dividend, the fact they've got a very strong grade rating. I mean, Baa2 isn't the best on this list, but it is a strong rating. It's a very low risk rating. They've got a disciplined investment allocation and they've got share buybacks. So when I look at share buybacks, the first thing that comes to mind is the share price. As I said, as a long-term investor, I don't want to see a share price drop. I want to see it be fairly stable or go up, and I want to have my consistent dividends. So the buyback says to me that they are quite keen to keep their share price stable and to increase it. And that's very attractive to me in investment. Now we'll also have a look at another document that they've had, and that is their growth plans. Now I know it looks like this is from 2003, but this is actually from their 2023 presentation. So here you can see that they're planned for growth. They're looking at oil and gas, and they're looking at sustainability and increasing their capacity to sustain. Now, net zero emissions is a bit of a buzzword with all these companies. Here they have their sustainability frame. So they want to get to net zero, they want to care for the planet, they want to improve people's lives. Now, again, this sort of thing is something that all these companies are doing. So I think going through the financials, it's quite clear why I have BP on this list. The fact that they've had consistent returns, the fact that they are consistently paying out these dividends, and they're so focused on keeping the share price high, it makes them a very attractive long-term dividend stock for me to invest in, and that's why they're on my list. Now we're going to talk about Aviva. Now this is one of the UK's largest insurance companies with operations in life insurance, general insurance, health insurance and asset management. The company has over 33 million customers and over £522 billion of assets under management. Now let's have a look at their stats. What I like about Aviva is the fact that they've got a dividend yield of 8.4%, dividend cover of 1.9, payout ratio of 52.63%. Now, normally a dividend yield of 8.4% would have me a bit worried because I think that's a bit high. Sometimes it's indicative of a company that's trying to bring in more investment because perhaps the earnings aren't as high. But they are a low risk investment with an investment credit rating of Aa3. So that gives me a lot of confidence. So now let's look at their financials. So I've gone through Aviva's mid-year results. So these are the interim results they've released in August of this year. And as you can see, they've done very well. I've pulled out a few sections from their presentation where they were talking about dividends and what they're delivering to shareholders. So as you can see, they've exceeded all of their targets in terms of their own investments and their sales goals and their cost reduction goals. Looking on the side here, you can see where they're talking about dividends, dividend growth and capital return. I'm always really happy when I see a company is involved in a share buyback, because what that tells me is they want to keep their share price high. And that's very important to me as a long-term investor, because what I'm looking at is I want investments where the share price isn't going to fluctuate. I want it to go up, I don't want it to go down. And if I'm getting dividends that are a percentage of the share price, I want that price to be as high as possible so I can get larger returns. So I like the fact that their interim dividend is higher than the previous year. I love the fact that they are doing that buyback. I see them as a safe, reliable investment. Let's have a look at their portfolio and what they're doing with their own investing. So as you can see there, they are quite diversified. They're looking at retirement, heritage, wealth, protection, and general insurance. Now, as a former financial consultant, I specialise in protection for quite a long period of time. Protection's a fancy word for critical illness and life insurance. That's what it is. You see, it only makes up 7% of the portfolio. Most of their portfolio is general insurance and retirement. Their investors know what they're doing. They are delivering. This is a investment that's going to be in my portfolio for a very long time. The next dividend stock we'll be talking about is National Grid. Now, they are one of the world's largest investor-owned utilities companies operating in electricity and gas, and they're here in the UK and also in the US as well. Now, they're a very stable, regulated business. They provide essential services to millions of customers, and I love the fact they have very predictable and growing revenues and cash flows. Now, I also love the fact that they've consistently paid and increased their dividends since 2012. And let's have a quick look at their stats. So with National Grid, their dividend yield is 5.7%, their dividend cover is 1.2, and the payout ratio is 83%. Now, that is a bit of a high payout ratio. There's still a good investment. They have a very strong credit rating, and let's have a look at their financials together and you'll see why I still trust and keep them as a core part of my investment portfolio. I watched the National Grid's UK investor distribution event in 2023, and it was quite informative. I love the fact that they clearly outlined how they'll continue to deliver to their shareholders. So I'll pull up some of the slides now. So on this particular slide here, you can see that they are committed to delivering a progressive dividend as they have done over the past 20 years, and that their total shareholder return is higher than the average for the FTSE 100. They've maintained that over the past decade. Now, they're talking about their projections, so they're quite keen to drive investment and growth. And as you can see, the UK electricity demand is going to continue to go up. They've quoted a couple of sources for that there, and you can see that they're looking to grow their company to accommodate electrification. What I like about this, and my takeaway from this, is the fact that they're quite confident, and I believe they're correct. They will continue to have a steady customer base here in the UK. As long as the customer base is steady, they'll continue to be a very easy and very sensible company to invest in. I'm confident National Grid is going to remain in my portfolio because they are so consistent with their dividends and they're committed to delivering to their shareholders. So next dividend stock on our list is British American Tobacco, one of the world's largest tobacco companies. They operate in more than 180 countries, have over 150 million customers. They used to be involved in providing various financial services. Of course, now they only focus on one commodity, and that is tobacco. And I should probably say nicotine, because they are moving over to what they call new categories. So new categories are alternatives to cigarettes. Now, I myself am a non-smoker, a non-consumer of tobacco and nicotine-based products, but I do have them in my portfolio for a number of reasons. First off, I love the fact that they've been able to pivot. Some people consider the tobacco industry to be in decline. Others say that it's not because they're entering new markets. I was a bit hesitant to put a company that's in an industry that's in decline because I am a long-term investor. I am thinking long-term. There's still a number of reasons why I do consider British American Tobacco to be a company that can survive and will be around long term. Let's talk about their stats. So their dividend yield is 9.4%. Their dividend cover is 1.5, which I'm quite happy about. Their payout ratio is 66.66%, and their investment credit rating is Baa2. Now they pay out dividends in February, May, August and November. Let's do a deeper dive into their financials. British American Tobacco did a presentation on the industry at the Barclays conference this year in 2023. Now I've been looking through the presentation, I've been looking through some of the financials, and the company is still in very good standing, and I love the projections that they have. Looking at the financials of British American Tobacco, you can see that my reason for including them is a little bit different from the other dividend stocks. And that's because this company is going through a bit of a test and a bit of a transition. At the moment, the sales from their traditional products are declining, whereas their new categories, as they call them, are growing, and they're growing rapidly. So it's an interesting one where, thinking long term, the stock price will stabilize and their sales will increase. That's my own personal prediction. Let's have a look at the presentation. Looking at some of the slides in that presentation, they were busting a couple of myths. So one of the myths they were busting was how tobacco heated products attract the most customers. They've clearly shown that vapor is actually the biggest contributor to consumer growth and acceleration. It's not market organisation and it's not tobacco heated products, it's vapor. So the other side of the coin is the fact that the industry value is declining with cigarette sales. Now they're showing a different perspective here. They're showing that although the tobacco industry is in decline, the nicotine industry is not in decline. So what I find interesting about this graph is the fact that they're clearly showing the sales of factory-made cigarettes are going down. The total value of the nicotine industry is quite stable and will actually grow as these new categories drive sales and increase the value. Now I find that perspective quite interesting and very intriguing, because what it says to me is that as consumer demands change and as the industry changes, they found a way to stay relevant and to stay profitable. When I watched their presentation, I found it very convincing and I was very intrigued by it. I think the fact that they were able to turn things around to the extent that they have is heroic and very inspirational. And I'm quite happy and very comfortable having this stock in my portfolio. So that is my top 5 list of UK dividend investments going into end of 2023. Now, I'm invested in all of those. I'm feeling very confident in my choices, but I presented that to you because I want to have a discussion. If you disagree with any of my decisions or my rationale for those decisions, or if you have any questions, comments or concerns, please leave a comment and we can have a fun discussion. You'll see in my description below that I have some links to different investment platforms. I need to stress the fact that I am not sponsored. I share those platforms because those are the ones that I use. I've got my various portfolios on them. For some of these, I have also shared a referral code. So what that would do is give you either a welcome bonus or free shares or reduced fees. I put those on there for the benefit of my viewers. If you were to use some of those links, it may be a benefit to me where you might receive £50 and I receive £50. All that's outlined in the description below, but it's there for everyone to benefit from. As you can see, I'm a relatively new channel, so if you are happy with my content or if you're unhappy with my content, please subscribe, ring the bell and look out for my new videos because I'm very passionate about this topic. It's one of the things I know best and I will continue to be putting these videos out for others to enjoy. Thank you for watching.